The green up here is what I call the base URL. That becomes key. That will be where you can get the archive on YouTube. If you add 2021 and join us on Saturday morning at 9 o'clock, you'll get to this live presentation. If you add the word handout to the year, month, and date code, which would be 2021 05 22, you'll get a 23-page slide handout that we'll be going over to. And to get to the archive of the specific episode, you just added the year, month, date code. And I'm Richard Calhoun, Creekside Realty broker for 40 years here in the Bay Area. I started doing this data back in 1997 to advise myself on purchases I was making at trustee sales. So that's a little bit of the background. We'll get right into it. The first 5 minutes is a quick recap. I ask you to hold your questions, and then we'll get those. After that, we'll go into in-depth detail on the data. So what we're looking at here is the available listings in the blue line compared to the 5-year median. And the 5 years I pick are 2015 through 2019. And you can see we're just a tiny bit below where you'd expect it to be. So we have slightly below the normal inventory. It's in the high 90th percentile. I would call it an absolutely normal inventory. What we do have going on is this red line up here, which is higher demand, higher number of offers being accepted. And you can see it varies between 20% and 40% above where you'd expect it to be. So it's not a lack of inventory in the global market. And the global market is Santa Clara, San Mateo, single family, condos, and townhouses. It's what I call the macro data. And this is based on 1 week's data. And then the gray line is just the number of new listings that we're having. And you can see that it shot way up this week, which is sort of interesting. Not sure why that happened. It's going to be interesting to see if that continues to happen. With Prop 19 passing, a lot of people thought there would be new listings coming on the marketplace. That hasn't happened as of yet, but maybe this is finally happening at the end of May. It also could just be a little bit with the holidays and the weather, but you never know. It takes more than 1 week to see a trend. Now, days of unsold inventory, in my opinion, is the single most important data point. And what days of unsold inventory is, it's the ratio between the supply and demand. And in a free economy, that's what drives future prices. And it also tells you how long it would take to sell the existing inventory at the existing rate of sales if no new listings came on the market. The purple line is the dividing line between 2020 and 2021. So it's basically a bar graph going across horizontally. And as it goes past each week, you get this current year's data. So what you have is the same concept. The yellow line is the 5-year median. The blue line, which sort of looks almost a little bit purple underneath the red, is the current data. So the current data is below the 5-year median. And when you're talking about days of unsold inventory, that's a faster paced marketplace. And you can see we got down to the low right here was probably the all-time low that we've ever experienced. Then we came up and we were hovering here, and it looks like there's this little bit of an upward trend here. It's not a huge trend. When the market does change, days of unsold inventory changes at about the rate of 3/4 of a day for each day. So over a week period of time, you'd expect something like a 5-day increase in the days of unsold inventory. We're nowhere near that level at this point. This is looking at the sale price to list price ratio distribution on every given week. We go back for, I think it is 22 weeks. The purple line is the most current, and it's hard to see because it's all these weeks are right on top of one another. All the solid lines are basically clustered right here, but you can see the purples here, then it shows a little bit here, comes right up through here. So, it's right at the top of the line. This is the best month we've ever had. And also for clarification, all this data now is macro data. So even this line out here, that's how the macro data performed back in April of 2018. This is the worst month we've ever had. The dotted lines are the oldest weeks. The dashed lines are the next oldest. So basically the market slowed down, turned around, and then heated up. And the more recent weeks are the hottest weeks. The purple, I would not say any of these weeks. The only week out of the solid lines that's a little bit slower is the brown week, which was the first one, April the 3rd. So everything since April the 10th through the present day is all basically the same. The reason the lines are different is just the weekly data. You're looking at new, fresh data every single week, and it's going to bounce around a little bit. Moving on, This gives you an interesting perspective. This median close of escrow tells you when the day that the 50% of the homes had closed by. So on August 10th, 50% of all single-family homes in Santa Clara County closed. That's later than, July 1st is the 50% of the calendar year, which is where you'd expect it to happen, except what happens is you have a downturn for Thanksgiving, Christmas, New Year's, Martin Luther King's birthday, and all that takes a couple more weeks, about 5 weeks, to go through the escrow process. And that's why this is shifted about 5 weeks past the middle part of the calendar year. This is the median price for each one of the micro market areas for the entire calendar year of 2020. And then this is the appreciation experienced for the 5 weeks ending April 10th, April 17th, 24th, May 1st, 8th, 15th, and 22nd. So when you look at Santa Clara County single family homes, it's the biggest, so it's the most stable. And basically you can see every single week there's been appreciation, and we're now 19% higher this year than we were last year. And that's not a whole year ago. That's essentially when this median day close of escrow happened. So basically the second week of August to now, there's been around 20% appreciation Santa Clara County single family county-wide, but it's not uniformly distributed. If you go down to South County, they're at 24.5%. If you go to Cupertino, they're sitting down around 10%, which is sort of surprising. But every area fluctuates at different times. And it's not a price-driven area, because here's your moderate low areas. That's like Blossom Valley, Santa Teresa, Milpitas, and North Valley, Berryessa. That's the second best at 23. So there is an affordability issue. And that's sort of what's happening, is people are trying to buy a bigger house during the pandemic, and they're going to the more affordable areas. And then you can see that San Mateo County is much slower. I don't have a countywide data. The expensive areas are up 12%. The coast is only up 2%. The Bay cities, those are like Redwood City, San Carlos, Belmont, Burlingame, they're up 21%. So they're doing pretty well. But, 17% for Redwood City, what is it, San Bruno, Coma, that area up there is at 17.5%. And that wraps up the quick presentation. So I'll pause and see if anyone has questions before I move on to the details. Not hearing anyone, I'll proceed. What this is now doing is looking at the inventory. This is the number of active listings by the different categories. So you have single family homes, you have condos and townhouses, you have San Mateo County, you have Santa Clara County. So in the last week, you had 420 currently available listings in San Mateo County. Santa Clara County was roughly double that. The previous weeks were not, we're a little bit lower at, 398. So let's go up 22 listings in San Mateo County. In Santa Clara County, it's up 39 listings, it looks like. In condos and townhouses, San Mateo County is up only about 8 listings. In Santa Clara County, it's up about 40 listings. So you can see that the current available inventory has jumped a little bit. You can see overall we've gone from 1815, so we call it 1800 to 1900. So you've had an increase of 100 listings in the past week that are available on the market. That's about 5% increase. If we continue to have that, it will start slowing down with the excess supply. But you can see that it was really that last week from one of the earlier slides where we had that huge jump up in the number of listings. So it's going to be interesting to see if that continues. Now you jump down to the number of offers. This is the demand side. Active listings is the supply side. On the demand side, I'm looking at 1 week data and then 5 week data. The reason I like 5 week data is it stabilizes quite a bit in the industry. And then you can also do a ratio, basically take what sold in the last week at 600, multiply it by 5, and you'd expect to be right at 3,000. This means that the 5 week number of offers is slightly higher than what it has been for the past week. So you have two things that are potentially going on here: is a 105% increase in the number of listings coming on the market, at the same time that there appears to be a little bit of a drop in the number of demands, the demand side of the equation. And then you can see the breakdown. If you take 115 2015 and multiply it by 5, you're somewhere around 575. So again, there was more sales in the past 5 weeks than in the past week. And if you take 309, multiply it by 5, that's almost right on the money. It's 1,545, and so it's within 2%. And in this case, there's actually been a little bit of slowdown or a speed up in the last week, a slowdown over the last 5 weeks. And then you can do the same thing for these other ones. This is almost identical. I would call it identical because you multiply by 5 and you get 2015. You're at 2014. If you multiply this by 5, you're at 675. So there's been a slowdown in the condos in Santa Clara County. Now, days of unsold inventory. This is the key metrics. And you can see actually when you look at that for the past 5 weeks, because of the combination of the two, it's at 18.6, but in the last weeks it's at 18.3. So the supply demand ratio has actually gotten a little worse in the last week for single family in Santa Clara County. It's gotten a little bit better. And the reason I'm saying better is anywhere down around 20, 25 days of unsold inventory is just too fast. The balanced marketplace should be around 40 to 80. So that would be sort of the ideal marketplace. Now we spend very little time there. We're either in a buyer's marketplace, which we don't spend very much time in, or we're in a strong seller's marketplace. And usually the only time we're in a balanced marketplace is when we're transitioning between them. Also, just from memory, it was only about 4 weeks ago, this number was 17, then it was 17.1, then it was 17.9, and now it's 18.6. So I disclose that's from memory, so I might be a little bit off when you look at it. So that's indicating that we're slowing down a little bit. Not a bad thing to happen. We're not slowing down at that 5 days per week level that I'm talking about. In fact, over what I'm reporting to be 4 weeks, we've only gone from 17 to 18.6. So you can't stay at 17 for very long, frankly. So I'm not sure there's much going on here, but it is an indication that the market is not as superheated now as it was 4 weeks ago. Now, if you look at the graph over time, this is days of unsold inventory. The red line is Santa Clara County single family homes. And right here, you can sort of see if that's the 17, and then we came up and we're slowly going up, and then you start noticing all three of the major components, which are single family in both counties, Santa Clara and San Mateo, and then condos and townhouses in Santa Clara. If all your metrics are going up and up in days of unsold inventory is increasing, which is a slowing down marketplace, we're so hot that that's not necessarily a bad thing. But what you want to pay attention to is, do these start shifting like this? Because if they start shifting that rapidly, then you have a change in the marketplace. Or back here with the pandemic, you can see how these are pretty dramatic shifts, where here it's pretty flat compared to the slope of the line. So I'm not talking about the duration, I'm talking about the slope, the rate of change of the line. Here's my map distribution. This is based on single family homes only, and it's going back for 5 weeks. The redder the color, the hotter the marketplace. And last week, I think I had this slide posted incorrectly. I believe it is correct this week. The numbers have always been correct. When you get down to only 10 days of unsold inventory, which I have seen in Cupertino, Sunnyvale, and I think the number I saw was 5.8 days, you're saturated red. From 42.5 to 77.5, you're no color, and you're at 110 days of unsold inventory, you're solid blue. So I used to have a much shorter range here. In fact, I think it was 22.5, and I blew it out because all these basically are faster than 22.5, and I wanted people to be able to see some idea by looking at the map where the hot areas were. These are all super hot. I mean, again, 40 to 80 is what I consider to be a balanced marketplace. So the only thing close to a balanced marketplace is Menlo Park, Atherton, not even Palo Alto, the stuff in San Mateo County, the expensive areas in San Mateo County. And after that, you jump down to 26.3 in Redwood City, then 24.8 in San Mateo, 23 in Palo Alto, and then 20. And then you're in the teens. So this is a very rapid marketplace. This is looking at active listings. We need to talk for a second about my definition of active listing, which is different than the MLS and most people's. Most people consider properties that the listing agent wants wants backup offers as an available listing. I do not consider that to be an available listing because it's under contract. A new buyer can't buy that unless the first buyer walks away. And that does not happen very often. A lot of real estate agents know it doesn't happen and don't even show properties where the listing agent's asking for a backup offer. And I always question, why should a listing agent take an offer that they're so uncomfortable with they want backup offers? But that happens, it's reported that way in about half the escrows. So the reason it's important to not count those is when you come into the first of the year, you've had very little inventory over the holidays. You're having a flood of new inventory come on the market, a flood of new offers. And often, if you look at my definition in the second, third week in January, that number's going down, where if you look at the MLS number, their number's going up. But what's going up is the number of escrows that are pending where the listing agent wants a backup offer. Anyway, that nuance aside, you can see that we're basically right on the yellow line, which means we have exactly the 5-year median. And again, the 5 years are 2015 through 2019. And at the end of last year, we had a surplus in demand or surplus supply. And the beginning part of this year, we had a surplus supply until about week number 7. Then it started plummeting down and we've been pretty normal. Going forward, I'd expect it to be normal. But, this last week, we had a lot of new listings coming on the market. Now, there may be enough pent-up demand that they all go away. Only time will tell. This is the number of new listings in the given week. So you can see last week we were here, and now this week we're way up here. So we had something like 770 new listings coming on the marketplace, and you'd expect somewhere around 600. So that's a dramatic increase. And the reason I'm not going all the way down here is this is because of Memorial Day. Memorial Day is a holiday. Every holiday negatively impacts real estate. I don't expect the impact this year to be as much because of COVID, but I am expecting it to be bigger than some of the past holidays since COVID because people are getting more comfortable and I think more people are going to start traveling. Now we're flipping over to the demand side. Demand side is how many offers have been accepted. And this is where the real issue has been. And it goes back not quite all the way to here, which is week 20 of 2020. And remember, the pandemic was all the way back here at week 10, and it's been overridden now by week 20, by 2021 data. But basically, we were below the number of offers you expected. We came up, we were normal for a little bit. And then basically starting right around Labor Day of 2020 since, you can see the blue line is significantly above. And in recent weeks, it's gone way above where you'd expect it to be. So that's the real story, in my opinion, is a surplus demand. And I think it makes some sense that the pandemic has changed the way people are living. Their home that used to be adequate is no longer adequate. And a lot of people are trying to move, and potentially what might be holding inventory back is some sellers are reluctant to potentially sell and invite people in if their house is working for them. But again, it's the huge increase in demand that's causing this imbalance that we're currently having. Now we're looking at the frequency of overbidding. This is how common is overbidding. And you can see it's running just a little, somewhere between 75 and 80% now for several weeks. It's up dramatically from where we were right after the pandemic. But we have been at this level, although I will declare that this level is essentially the highest level we've really been at. When I say about the highest, we've hit 75, we've hit 80, we're right in that same range. This is looking at, the frequency of each component. You can see single family homes in Santa Clara County is the top. It's above 80%. I don't know what the number is. I would guess about 82% of the sellers are getting more than their asking price. San Mateo County looks like it's pretty solid, right around 75% of the sellers. And condos in Santa Clara County are getting about 72% of the sellers are getting more than their asking price. And this is the overbidding distribution geographically. Cupertino, Sunnyvale, 96.5% of the sellers are getting more than their asking price. And this does not include those that are getting their asking price. So that means less than 3.5% of the sellers are getting less than their asking price, which is pretty phenomenal when you think about it. All these numbers are pretty outrageous. The only one that's halfway in balance, again, is the expensive areas in San Mateo County. But again, at 43%, that's almost half your sellers are getting more than they're asking. But again, you can sort of see the distribution of the hot spots over the different two counties. This now is changing from frequency of overbidding to magnitude of overbidding. how much over are they getting? And you can see we're between 108% and 109%. We did hit 109% back here. I think that's week 15. We're now down around 108.4 or something like that. Right as the pandemic was happening, we were down almost essentially at 100%. We pretty rapidly came up to about 101. Then we hit around 103, 102. But now again, we're getting close to record high. Yes, we've had higher. San Mateo County, I think, peaked out at about 112%. I think Santa Clara County peaked out at 110%. But, we're getting in that order of magnitude. It doesn't surprise me that the order of magnitude is lower and while the frequency is at a record. And that's because the pandemic is what I call an insult to the market. And anytime there's an insult to the market, buyers are more conservative with the degree of their overbidding. This is the distribution of overbidding. I'll point out that even, South County with its rapid appreciation, they don't overbid as much. And they don't have a long history of overbidding in South County. North County, we've been overbidding since 97 and we're used to it. So our numbers are much higher. You can see Cupertino, Sunnyvale at 115%, Milpitas at 112%. Those are pretty strong numbers. You go down to Foster City, 113%. The Daly City, Coma area in San Mateo counties at 114%. We've already seen this slide. I'll just go over it a little bit better, maybe a little differently. Each week is shown here. The dotted lines are the oldest weeks, and there's 8 old weeks, and then there's 8 moderate weeks and 8 current weeks. And that should be 24. You use up 2, one for the best month and one for the worst month. But the key is all these solid lines in the most recent 8 weeks. And the only one that isn't clustered together is the April 3rd. The others, all since April 3rd, are basically from my experience, I would say there's unchanged. You've come up, you've hit a plateau, and you're basically there. I think what we're going to start seeing in the future, and predicting the future is pretty scary. I think we'll come down a little bit, but that typically happens, and that's the only reason I'm predicting that. Typically, you hit somewhere around this time of the year, and buyers start going, well, prices can't keep going up. I'm going to wait, and that causes prices to sort of level off until we go through and do the same thing again next year. Here's just the same thing, but only 12 weeks. So now you can see the purple line, the current line, a little bit better coming down through here. Right through here, it's sort of tied for first place, but down here at the lower end, it's not. It's coming in second place through here. Up here, it's down around 5th place or something like that. So, I would call that just fluctuation based on each individual week's data. I don't consider it to be a huge change. Now what we're doing is we're going away from macro data to single family homes, Santa Clara County only, and we're looking at May. So this is May 2021. I will point out that we're not through May, and my definition of May is May 1st for 35 days, which is through June 4th. So I can't have this data till June 5th. But what I'm doing is month to date. So this is May 1st through last night at midnight. So May 1st through May 21st, plotting it. And here's where we are. So Santa Clara County single family homes is having the second best year we've ever had. And I never thought we'd get close back to 2018. Those that weren't around from basically August of 2017 through about July of 2018, we were just on fire. We had a whole second round of appreciation that we never had before and haven't had since. And now we're right there almost again. And I never expected that. But that's what people are doing in the pandemic. They're trying to buy single family homes over condos and townhouses. They're trying to buy in Santa Clara County over San Mateo County to get more house for their money. This is the sold price. So this tells you where, if you're trying to find out where you can get the most house for your money, it's pretty much a direct correlation. It's not exact because the house availability changes the size of the typical house, etc. But this is the median price, and the color is set based on the median. The median is the middle number, which is all most people follow. I add to that the 10 percentile, so that's the lowest end of that marketplace, and the 90 percentile. So using South County for an example, you can say that 80% of the homes are between 850,000 and 1.7 million, with the median being 1.2. You can fairly quickly pick what geographical area you want to focus on or which ones you can rule out based on the prices. For example, in Cupertino, if you're only going to spend $1.5 million and the cheapest 10 percentile home is $1.8 million, yes, you can look there, but you shouldn't focus your effort there because the chances of finding a house for under 1.8 million is pretty slim, and 1.5 is going to be significantly lower. Now, if you're looking for a tear down fixer upper, you could probably pull it off if you give yourself a long enough period of time. But this gives you an idea of the range in the different areas. And then what I'm doing on this slide is, again, I'm only focused on single family homes in Santa Clara County, and I'm looking at May 1st to present day. So you can see that I can't get the data till June 5th. I'm using, and it's sort of like a hybrid for number of sales. I am using the last 5 weeks because otherwise this number would be really low. I think it's going to be pretty accurate. There is an increase at this time of the year, so it may actually be a little low, but it's the right order of magnitude. So if you look at days of unsold inventory, and the reason I'm pointing that out, I could take May 1st through May 21st and divide by 21. And that does work out for this month because there's going to be an even number of days of the week in there. But for a lot of months, when the first doesn't fall on a Saturday, which is most of the time, you're going to have an uneven number of days of the week. And there's a huge cycle based on the days of the week. I decided that it was better to use 5 full weeks and then average it. So if you just keep in the mind that this is a ballpark number and not a precise, you can come all the way back to 2012 before you can see selling more homes than that. And from that point backwards, we sold quite a bit more. And that's the slowdown in the marketplace that had been happening over the last several years. And this is going back 2 decades. You know, you can see back in 2004, we actually sold 65 homes a day. So even though we're talking about having a huge increase in demand, it's actually a reduction from what we were seeing in some of our banner years. And it's not even at the norm, because here you have 2002 at 41, 49, 65, 55, 41. So all through here, you can see the number of offers accepted. The demand was actually greater and the values expanded. People are just staying in their homes for longer and longer periods of time. Moving down to closings, here you can see the actual magnitude of overbidding. And so here in Santa Clara County, it's 109.8%. You can see that it peaked out at 110.6% in 2018, which was that best year. You can see 83.5 for the frequency versus 82.6. So there's not much change, but this year is a little bit slower, just like that graph distribution line showed. And then you can see the huge increase in price. I mean, 2019, 2020 was fairly flat all the way back to 2018, and now all of a sudden we've had something like a 15% increase, and that's across all your different price ranges. Not only did the lowest 10% tile go up, the median went up and the upper end went up. And the reason I track that, it's not always that case. Sometimes one end area moves and other areas don't. For example, if you come back to 2015 to 2016, the upper end didn't move at all. The lower end really didn't move too much. It went up, but the middle moved up by more than 10%. So that's the goal. Not only do you get a sandwich effect, you can see what's happening at the different levels of the marketplace. And with that, I'm done. So I will pause and see if anyone has any questions for me. And here are the URLs if you didn't get them initially. So does anyone have any questions for me? Yeah, Lily.
Oh, okay. I think what you're saying is that starting from this month, May, I think that you don't see too much well, how do I say, too many activities until next year. Did I get it right?
You got to close. That is what the normal marketplace does. Basically, the normal marketplace does a step function increase somewhere around the middle of January. I believe it really happens the beginning of January. It happens right after, buyers come out back from the holidays. It shows up in the data right around the middle of January. Then you tend to have a rapid increase because nobody believes there's a step function. So there's a rapid slope up, and that slope continues, for different periods of time, but the general period is somewhere around middle of April to middle of May. I think we're there this year, but we're so hot. There's going to be some continued appreciation, but that's the period of time when you typically overshoot. And when you overshoot, that means that prices flatten out and come back down a little bit. So even though there will be some appreciation in the next several weeks, and from what I'm seeing, that probably is not long-term stable appreciation. And come September, October, November of this year, prices will probably be at that level or below. But we're in such unusual times. One, you can never predict the future. Two, we're in such unusual times that you don't know. But there are indications, and the strongest indications that's not a prediction is that days of unsold inventory. It got down at 17. It's now, I forgot the number, maybe 18.7. That's a slowdown. And when you're at that level, it's noteworthy, but it's not the kind of level that says the market's changing. But when the buyers are starting to, if all of a sudden the buyers start feeling that homes aren't going away quite as quickly, then they may overbid as frequently, but they'll come down in their magnitude less because they won't feel so desperate. And that's what's going to roll the price down and stuff. So, every indication is we're sort of at the plateau, but there's no way to predict the future.
And also, I noticed that the number of new actives are increasing.
The number of new active listings is up dramatically this last week, and I don't have this data historically. I would almost wager that's a record high number of new listings coming on the market in any given week. Now, it may be as simple as people are saying Memorial Day is coming up. You don't want to list your property. At least I don't want to list a property the week before a holiday. So there may have been a rush to list the properties last week, and there may be a drop. In fact, I'd expect a drop in the number of listings next week. Historically, the surplus in number of listings come the week after the holiday. The whole marketplace is continuing to change. People are spending more time staging properties and things like that, so they know what's coming on the market for a longer period of time.
Right. Good. Thank you.